So I hope that is fine with everyone. If there's anything you want me to know before we start, would you like me to say anything? Is there something you want me to concentrate on? Precious and peculiar.
For me, I think that's fine.
Okay, 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 okay. Peculiar.
Yes,
Anything?
that's fine. That's fine.
That's fine. All right. Okay. So yeah, yeah. Okay. It's 8 o'clock, so we can just start. All right. So today our goal is to have a very good um revision and also to prepare ourselves for the examinations for audit assurance and forensic examinations. It's not a new course, it has always existed. The only thing that we can say is new is the addition of forensic into this. So before we get into the revision proper, let me just zoom in into the kind of things you should be looking out for, in the examination. Now, the first thing I want to highlight here is that you want to pay attention to the forensic part. I hope you can see my screen. Can you see my screen? Can you see my screen?
Yes, yes.
Beautiful. All right. So you want to pay attention to forensic. So we saw ICANN, did a lot last year. Last diet, a lot of questions, they brought in questions on forensic, and we expected it. Being the first time they were going to add that to the syllabus in terms of even the name of the, text even changed, and forensic was included. So that they are kind of moving into the fact that forensic is a very important, skill for our professional accountant. So you want to pay attention to that chapter, and that chapter is the last chapter, if I'm not wrong. Yes, that's the last chapter in the pack. So there's a possibility somebody might not read it because it's the last. So a lot of attention might be given to the early topics, but that last chapter is where the forensic is. You want to pay a lot of attention there. All right. So, for the examination proper, you want to be able to interpret the question such a way that whatever it is you've learned in that chapter, you're able to bring it to fore. Okay, so we'll get into that, how to really do that in practical terms. So the second thing I want to highlight here is there's some topics, we call them high frequency core topics. All right, so these are topics that somehow find their way, in every diet. So I'm going to mention them. So you just pay attention to them. Now, we're not saying the other topics, are not important. Other topics would also come up, but what I'm saying is, you don't leave these ones to chance. And even the other topics too, you don't leave them to chance because somehow they still bring those other topics in between. But these ones, you don't want to joke with them. And so I'll just call the topics and the chapters, right? Um, chapter two, chapter one, for anyone just getting into audit for the first time, yes, pay attention so you have a good, foundation. But chapter two, don't joke, professional ethics. Don't joke with that chapter, it's high frequency core topic. The chapter six is also a chapter you don't want to joke with, and chapter seven and eight. All right, so I hope you're jotting them down so that you can just quickly cross-reference in everything I'm saying later on. All right, so
Yes.
okay, so I'm going, I said chapter two, which is professional ethics, chapter six, chapter six, chapter seven, and eight. And of course, because I also mentioned forensic, so you also include that, which is chapter, 15. But make sure you read forensic properly. Don't overlook it. Now, the other ones I want to talk about now is the substantive procedures. Now, this one comes in chapter 9, chapter 10, chapter 11, chapter 12. So from 9 to 12, this topic comes in and it was broken down into 4 different parts. So we have introduction, we have, if you go through them, you get to see what I'm saying. All right, so they have those parts. Now, what do you want to pay attention to here? Because it's more practical. Those 4 topics are like practical aspects, so it's more realistic. So this is the kind of chapter where when you get up and questions, it's probably a case study, citing, an organization and expecting you to do something based on, and so you don't want this one, you need to know what to do. All right, so Let me also digress a bit. If you're going to be answering questions on case study, what should you be paying attention to? Now, case study questions are not questions that you repeat the case, because we've seen that students are literally just retelling the story. We don't retell stories in case study. Now, the case study is going to come with a lot of interesting lines and interesting things, and you might just get carried away. After you've read the case study, your core is to go to the requirement. All right, so the case study is good reading, but requirement is what tells you what to do, not the case study. And the case study is going to be so many issues that you want to write on. You want to put it's like it's written in such a way that you want to put your own comment on it. You want to say something about it. You want to, reply to something somebody has said. So it's so strong on you. You want to do that. But that's not what the examiner is looking for. The requirement is what the examiner wants to see how you've been able to approach the requirement. So for every case study questions, we're going to be looking at some of these questions. For every case study question you see, there's always a requirement. And so you're going to be led by the requirement. Don't be led by the case study. Now, the requirement to say, for instance, identify, the substantive procedures, to be carried out on non-current asset, identify how cash or bank should be, it's going to go straight that way. And you're going to answer that question exactly that way, right? So you pick the requirements, pick the answer to that according to what you've read in your pack, in the slides, for those that, subscribe to the platform, your slides are there. Quick check through your slides. You're going to write that. Now, the only thing you're going to now do is you then now link it to the case study. So you've written the real answer based on your pack, based on what you've read, based on what you know. Then you're now going to, just put like some lines in there after you've written your answer to now link that issue you identify to the story or to the case study. All right. And you're not linking it in a way that you want to extensively talk about the story. Just linking it, saying that X, Y, and Z company, should have, carried out these substantive procedures, or they could have or should have, carried out an analytical test, X, Y, and Z. So that's how you link it. But the real answer is still based on what you've read, what you know, not an extension, not like rewriting or re-narrating the case study. All right. I hope that's taken. All right. So another thing you want to also take a bit of care is the chapter 13. Now, chapter 13 is on the reporting. So that's where you have completion and reporting. Now, why are you taking the care there? Because everything kind of rises and falls there. Everything you've been doing from chapter 1 to 12, all these issues are going to end in chapter 13, because it's in chapter 13 you then get to understand that, okay, am I writing a report or not? Especially if it's a scenario-based question. If I'm not, the essence of all of this is for me to write a report. Or sorry, as an auditor right now, the essence for me to give an opinion, and I'll have to do that in an opinion. So have an idea of what that looks like in terms of understand elements of what an audit report is. Now, you may not be told to draft at your level. You may not, all right? May not doesn't mean you cannot, okay? You may not be told to draft an audit report. However, knowing the condiment in an audit report will really go a long way to situate, so many things, in this examination. Because when you know the content of an audit report, if a case study is referring to something that would refer you to talk about something in the auditor's report, you know exactly what it is. So you want to just have an idea of that. I would also like to say, if you have the time, pick any financial statement of any company and just look at the auditors. Just look at it. Once you look at it, it makes better sense, right? When you see a real auditor's report, you would to make a lot of sense. Okay. Now let's now go into the practical aspect. So this the first thing we'll do now is let me do like a summary of all of the chapters, and then we'll now take examples of past questions and see how we're going to approach the answer in the past question. All right. Okay, so the first chapter we're looking at is the first chapter, which is concept and the need for assurance. That's the first chapter. Now, what should you be looking out for in this chapter? Well, everything in the pack you should be looking out for that. But since it's a revision class, what are we going to highlight, in the course of this class? So you want to be able to understand the objective of an audit. See, at this level, they want you to be able to know what an audit is, right? On no condition should you fall into the expectation gap, of how the general public think an audit is. So there's a general public, thought that an auditor's job is to detect and prevent fraud. There's that general notion in the public. You cannot even ever make that blunder. The moment you make that blunder, you don't have a jack understanding of this entire thing. In fact, it's like a good reason for the examiner to say, I think this person should better come back next day to write his exam, because even if all things check, this is really bad. So you need to understand the audit objectives, and which is very clear to express. Now, mind my use of words, because in audit, you have to learn to use the right words. You don't write in English. What I mean is, you don't just write as it's coming to your head. You write according to the words or the wordings. Remember that this course is guided by standard. And anytime any course is guided by standard, and then you have to theoretically answer questions from that, the best place you want to be is ability to use the same words that were used in the standard. All right. So that's the best place you want to be. So the objective of an audit is for the auditor to express an opinion on whether the financial statements are prepared in all material respect according to an applicable financial reporting framework, right? You need to know that. So your keyword must be there. You must be able to use the word express, opinion, financial statement, material respect, applicable financial reporting framework. You want to use those words, the T. You don't dilute it. You want to use them. All right. So you can then move things around anyhow, but you want to use those keywords. And that's the one secret to audit, your ability to use the keyword. Because the stories are a lot. Examiners are going to be bored by your story. But if they see keywords flying everywhere, they feel like, yeah, they're confident this person knows what he's writing. So you want to chew your keywords properly. Another thing you also want to know is you want to be able to tell the responsible party, right? And the person responsible for the preparation of the financial statement is the management, okay? You want to know that. And then the next thing is the assurance, because the course says audit, assurance, and forensic. So the assurance, you need to understand what assurance means. So when we talk about assurance, we're saying an auditor wants to give some level of comfort, to whoever the report is targeted towards, right? So the question is, what kind of assurance do we have? So generally we have reasonable assurance and we have limited assurance. Now, your reasonable assurance is talking about a high level of assurance, but not 100% assurance. So do not state it that it gives all assurance. No, it only gives a reasonable or high assurance. And what gives that kind of assurance is statutory audit is where you get that kind of thing. You don't get it in a review. You don't get it in a compilation. You don't get it on an attestation. You only get it in a statutory audit. A reasonable assurance is only gotten in a statutory audit. And we also say it's given, it's a positive opinion. So the opinion that will be expressed is positive, So then the other one, which is the limited assurance. Now, the limited assurance is the moderate assurance, right? And this is given, for instance, in a review engagement, all right? And the opinion is always in the negative, okay? Opinion is always in negative. You want to use these words like clearly the way I'm using them. Don't mix them up. Don't water them down. That's how you want to use them. Now, the other thing you also want to be able to remember in this chapter is the element of assurance. Now, what are the elements of assurance? There's a three-party relationship, which is one element, and in that three-party relationship, we have the practitioner, right? And the practitioner is the auditor, is the person giving that assurance, right? And then we have the responsible party. Now, the responsible party is the management, the people, that have the responsibility in preparing the financial statement. And then we have the intended users. Now, the intended users are shareholders if it's a public interest entity. So you want to also be clear in your write-up, right? So depending on the case study you're given, for public interest entity, it's not 100% the same as non-public interest entity. So for public interest entity, they have a statutory obligation to prepare to carry out a statutory audit. But for non-PIE in Nigeria, do not have that, but they encourage to if they can, but there's no, it's voluntary for them. So you want to remember these three elements, three party relationship, practitioner, responsible party, intended user. And then the subject matter, right? There's a subject matter, there's a suitable, criteria, which is the framework, the applicable framework. The subject matter is the financial statement or whatever it is that has been, reviewed, right? Then there is an evidence, right? Evidence is how the auditor will come to that conclusion. If I'm going to be giving an opinion on something, the question is what did I view? How did I arrive at that opinion? And that's the audit evidence or the evidence. And then there is an assurance report which summarizes my findings or summarizes my opinion or where I put in everything else I've done, right? So you remember that. So those are the elements of assurance. So let's quickly go to chapter 2. If you are following, if you think, if there's anything, let me know. Are we good to go? Can I continue? Can I get a response? Are we good to go? Can I continue?
Yes, yes.
Okay, all right. Please let me know if you need me to go back or say anything else. Okay, so this chapter 2 talks about the professional ethics and code of conduct. This is very important. You need to know them all because you're going to be a chartered accountant. You need to know them. So at your level, at least you should know what they mean. So the fundamental principles, which is in line with the IFAC code of conduct, is also in line with ICANN code of conduct. So that it's the same thing, right? So we have integrity as number one. Well, let me not say in any particular order, but this is the order. But even if you don't put it in this particular order, you're still good. All right, so don't be finicky on trying to remember the order, but if you do, that's fine. So we have integrity, we have objectivity, we have professional competence and due care, we have confidentiality, and we have professional behavior. Now, integrity talks about being honest. So that word honest, you want to use it. If you're going to be explaining it in everything else you want to say, you make sure you put the word honest. All right. So objectivity means not being biased, so you're not being subjective, just being objective. Then professional competence means to be skilled, to know what you're doing, to be skilled, to be like an expert. So professional competence and due care. Due care talks about diligence, being able to properly carry out your work, in order to bring good credit to the profession. And then we have confidentiality, which talks about you not disclosing the client. So you see those words, you use them the way I'm using them. You not disclosing the client information to third parties, except required by law. All right, so there's an exception to confidentiality. So if it's a case study, you're looking out for those exemptions, right? So the moment you see those exemptions, you don't breach confidentiality, again to that client. So you want to look at that. So except it is required by law or for professional purpose. Anyone can you turn off your mic? Mute the mic, please. No? Okay, good. So I was talking about confidentiality. So confidentiality means, not disclosing information, to a third party, the client information to the third party. And the exception is, except it is required by law or except there is a professional duty or right. See, these words are what you see, your wordings are very important, right? So, except, I said, except there's a professional right or duty to disclose. And the last one is professional behavior, right? So this talks about compliance. As a professional accountant or a practitioner, you want to be compliant with the relevant law. So you're putting yourself in the position of the question, depending on how, where the question placed you. Most likely, the question will place you as a practitioner, as an auditor, right, or practitioner. So you're being placed at that level. So you speak from that level. You're not speaking if it's a scenario-based question, but at your level, it's not as deep as the higher level. You still need to, show some level of, knowledge there. So you speak from that level. Professional behavior means being compliant with the relevant laws and regulations, So you're also looking at the questions. Are there, professional accountant in those questions? So, right, for instance, you are the practitioner and there's a chief accountant who is also a professional accountant, and for some reason they violated it. So you want to also mention that the profession, accounting professional, ICANN or IFAC, expect these fundamental principles, and the professional accountant has to be compliant with the relevant laws and regulations. All right, so that's something you want to mention there. Okay. Then the next thing is the threat, because you could have cases where you then are posed with threats, and then the question wants you to evaluate those threats. So what are those ethical threats? We have self-interest. You don't water them down. It's the same word. Use it. Self-interest, self-review, advocacy, familiarity, and intimidation threat. All right. So self-interest threat talks about when you as a practitioner, you're taking a decision for your own self, interest, which could be for financial gain, right? So maybe you're going to get something in return, right? And then we have self-review, so where we're saying you as a professional accountant, you don't want to be in a situation where that gives rise to a self-review. Okay, so you have provided the information. Your company was the one that did the internal, or the internal control was outsourced your company, and you're still the same company auditing that same financial statement. That's a self-review, because you won't want to say you have done it wrongly, right? So that's self-review. Then we have advocacy threat. All right. So advocacy threat talks about when you are in a position, where you have to, represent your client. You have to represent maybe in a legal dispute or in the court of law, and then as a result, you don't want to you don't want to give your comment because you don't want to, because you don't want to be an advocate. All right, so you don't act as an advocate, for an assurance, client in litigation or dispute with third party. So these are things you want to look out for in the case study. And then we have, so when you identify it, it's not like you say it didn't happen. You've identified it, and you're going to mention that there is an advocacy threat here. The professional accountant, will be is meant to now represent his client in the court of law, which can be an advocate, advocacy threat. And then there's familiarity. So you want to identify in that case study, are there familiarity issues? And sometimes the question might not even be a case study. I just wanted to explain what they mean, right? So familiarity is saying, well, are there close relationship, with the client and the professional accountant or the practitioner, and you identify them by saying, oh, maybe family relationship, business partner relationship, or constant, the audit firm or the professional accounting firm has been the same firm auditing the firm, for so many years, and as a result has brought into familiarity into that. So you want to mention all of that. And then you want to talk about intimidation threats, right? So this is where there is an undue influence on you as a professional accountant because of certain influence, your client might have on you, or your boss can have on you, even your own profession and your own auditing firm. So is there any form of intimidation? So you want to look at where the question is putting you, and then talk from that point of view. And if it's not a case study, you want to talk about, the word intimidation threat means being influenced, by fear or being threatened, because the client might have a dominating attitude, or it's probably aggressive. So you want to use this word, basically just so that it can drive you, because it's not about story, right? You want to use the right words to help you drive your answer. Okay, so that's it about threats. What else? What else in this topic? Okay, yeah, I think that's all for this topic. But of course, you have your slides, it's more elaborate, but this is just like a summary. Then the third chapter is obtaining an engagement. All right, so obtaining an agreement is talking about how you, as a practitioner, how you go about in accepting an engagement, right? So, what are the procedures, to be followed in accepting, an engagement? So, what are you looking for? So, if you get a question, whatever it is, whether it's a case study or not, or scenario based or is not, what are you looking out for? Okay, are there potential threats to the acceptance, of this engagement? What I mean by potential threats is, are there threats to the fundamental principles? We've talked about them: integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. So are there threats to this thing? So that's what you're looking out for. You want to be sure that you have that professional, clearance, all right, before you get an engagement. You also want to identify that if your firm wasn't the auditor that audited the firm in the previous engagement, you want to have clearance from management of the client to be able to speak to your predecessor, right? That's the former auditor. You want to be able to speak to them because you have that duty to do that. So if you're not given clearance to do that, you might not even want to take the engagement, because if you don't have that, it might just mean that something might go wrong. So those are the things you want to, but at your level, you just wanted to exercise the use of your words, being able to explain that, potential threats are not imminent in the engagement, and you're able to clear that these things are not, and you're able to also, have that clearance to communicate with the predecessors, that audited the firm. Okay, so basically chapter 3, what else? What else? What else? That are important here. Things that could be checked. We also talked about issues around fees, how do you quote fees, advertisement, are you allowed to advertise? Yes, but what are you not allowed to do? Anything that will bring a discredit to the service, to the profession, advertisement that can be misleading is not allowed. Something that is falling short of regulation, not allowed. All right. So when it comes to fees, we talk about, lowballing, you quoting fees that is ridiculously low. It's even do the job, or you want to use it to take clients. It is not, you're not supposed to do that because that might threaten, once that happens. So if you see that in the case study, means it might threaten yours. It might be a self-interest threat because if you're taking an engagement, cheap just because you want to get a client, you might want to keep the client at all costs, and as such, might want to break some of the ethical codes, just because you want to keep, clients. So, in as much as it's legal, but thing is, it poses threat. All right. So, lowballing, fine, you can quote any price for your client, but the question is, based on that issue, can we identify that there could be some threats, in that engagement? Okay, so that's something you want to know. And when we talk about engagement acceptance, we talk about the fact that you want to be sure you have the experts required to do the job, you're competent enough, you've ensured you've checked all the safeguards to be able to engage the client or take up that engagement. Okay, so yeah, I've talked about professional clearance, ability to speak to your predecessors. All right, so yeah, I think that's about that. Yeah, okay. Also in that chapter, we talk about auditors in terms of who has the power to appoint the auditors. The shareholders appoint the auditors, right? And the shareholder also can remove, the auditor, and they can do that through the directors, but at AGM, at the annual general meetings. All right. So can the auditor resign? Yes, the auditor can also resign. What are the issues that may make an auditor resign? if he thinks the management has demonstrated lack of integrity, if his fees have not been paid, if he feels the client is not even profitable for him, these are reasons why he might decline or resign, his audit, engagement with that client. So yeah, I think okay, yeah, we'll also talk about engagement letter. What does an engagement letter is? It's a letter that shows, after the auditor has been appointed, now the audit firm will now write, an engagement letter to the board of directors, right? So the engagement letter, what you should remember here that it contains, the objective and the scope of the audit. So the auditor then will get to write the objective of the audit and the scope of what his own audit was going to cover. It also includes the responsibilities of the auditor and the responsibility of the management. Is able to also identify the financial reporting framework for us in Nigeria is IFRS that is going to be used. And you also kind of give a reference to the form and content of the auditor's report. So remember those condiments of an engagement letter. You need to know that. So it's written by the auditor or the practitioner to the client, all right, indicating all of these things I've mentioned. Okay. I think that's it for that. You can be going through your slides. If there's something you want me to emphasize, and just let me know. Then we have the fourth chapter, which is the internal audit. Now, this is quite different from everything else we've been doing because this internal audit is not really about the external auditor. Neither is it about, we're not talking about the professional accountant standing as an external auditor here. We're speaking about the accountant, professional accountant within the organization, employed by the organization. So it's the staff of the organization. So what should you be what should you remember here? You won't be able to distinct between what an internal audit is and what an external audit is. You should be able to draw that clear distinction. It's expected. All right. So remember that may not just holistically ask one topic in a question, right? So question one, they do not necessarily have to ask a topic, just internal audit or just professional code of conduct. No, one question can have a mixed match of 3 topics. So please be mindful, and they will put them together, in the same question. All right. So depending on how they think it's related to one another. So please be mindful of that. Okay. So back to what we're saying, you should be able to tell the difference between internal audit versus, external audit, and how if you're going to be writing those differences, what are you looking out for? The fact that you want to understand that external audit is required by law. It is a statutory audit. Internal audit is not a statutory audit, right? So another thing is who appoints the external auditor? The shareholders. Remember that they appoint the shareholders and they expect independence because the external auditors are not part of the firm. But the internal auditor is employed or appointed by the management, right? I'm using that word employed because is employed, right? So, but we can use the word appointed, but he's actually an employee. So he's appointed by the management, and as such, the level of independence might not be visible, as we expect in an external audit. Okay. The duties of an external auditor is according to the law, which is according to the statutes, which expect them to give an opinion on the financial statement, right? While the management defines the duty of an internal auditor, right? What they want them to do. All right. So they define it. The report of an external auditor is addressed to the shareholders, while that of an internal auditor is addressed to the management. Okay, so you want to remember that. But what if they ask you if there are similarities? Yes, there's a lot of similarities. How do you want to say it? In the sense that they both involve some form of audit that require you checking the financial statement. But the internal audit is different because this time around they are looking at the examination of the internal controls. They're also probably establishing the internal control, the firm. But the external auditor don't do that. You just confirm whether the control is strong or not, and that helps them to know what next step to take. Okay, so you want to being that certain skill sets are required for both, for you to be an internal auditor or to be an external auditor. So what else? What else? What else? Yes, then the value for money. So in this chapter, we talked about the value for money, which is the VFM audit. And what does this talk about? Basically, the value for money basically is saying how the organization can get value from the money they've invested in the organization. All right. So for companies like public sector organization, it's more like value for money. So what are the three E's? So we're talking about economy, efficiency, and effectiveness. So when we talk about economy, we're saying that we're not spending more than it is necessary, right? So when we talk about efficiency, we're saying that we're getting high, volume of output from the resources that we've used. So we're getting better use of our resources, right? Why effectiveness? We're achieving the objectives of the entity. So you want to be able to differentiate that. Those are the three E's in the value for money. So in short, you want to write, I hope you're jotting for. Okay, so if you can jot, it's also because it also helps you to remember. So for economy, we're saying we're doing it cheaply, as in short. Efficiency, say we're doing it well, right? But effectiveness, because we want to do what your original objective is, so we're doing the right thing. For effectiveness, we're doing the right thing. Okay, so what else? What else? What else? So many things in there, but just highlighting things that yeah, it's there, it's in this topic. We'll talk about sourcing, right? Where companies can actually outsource their internal audit, right? And they are sourced to firm. And we talked about the benefits of outsourcing, benefit that helps you to get skilled people to do the job because you may not have them within your organization. It also helps maybe in terms of cheaper, cost effective because you don't necessarily need all the paraphernalia of setting up a proper firm to be able to do that. You can just pay one off and then somebody else does the job, right? So these are some of the benefits of outsourcing. Um, what are the problems with outsourcing? Confidentiality issue. Somebody else is seeing your company. Imagine somebody else is in charge of your internal control. They get to know everything about your business and they could use it for their own personal use or for their own other reason. So there's that. And there's also the issue of loss of control. Because somebody else is managing that, you may not have that kind of control you want to have. There's could be conflict of interest, where the internal auditors, imagine the firm you have outsourced the internal audit work because they're now your internal auditor, so to say, and now the same firm that will be doing the external audit. So there could be conflict of interest, the same firm, and that could actually impact on independence, and objectivity. So those are the things regarding outsourcing. What else? Okay, I think that's it. So chapter 5, we talked about audit planning and risk. Okay. Now, this chapter, this is where we talked about the strategies, that an auditor would use in order to plan, his audits. Okay. So there are two things. There's audit planning and there's risk. So let me expand on the audit planning. All right. So because if you're going to be giving an opinion on something as an auditor, it's important that your process was even correct. The process validates the end, basically. So your process should tell us, it should give us better, information about the result, not that the process itself is, faulty. So that's where we then talk, okay, there should be an audit plan, which is the plan that helps you to be able to know your goals, and how you want to achieve that. It helps to know what needs to be done to be able to achieve the objective, of the audit. Okay. So basically, what are you looking at for your audit plan? You want to look at for who is doing what in terms of staffing. You're looking at timing, when will this work be done? You're looking at the scope, that is what work is to be done. So those are the three things you want to remember when it comes to audit plan: who, when, and what. All right, in audit plan. All right. So what else we expect in the planning to the auditor is also aware of being professional skeptic, in the sense that he has an inquiring mind, he has an attitude that helps him to be alert, to conditions that might indicate, there might be misstatements, or fraud or error. So he has to be a professional skeptic, right? So professional skepticism is expected. Okay, so why do we need to plan the audit? Why? Because it helps the auditor to even organize and manage the audit engagements. Remember that professional accounting firm have diverse engagements, right? So they audit for different firms. So if they're able to plan their audits, it can help them to organize and manage. It also helps them to be able to pay attention to important areas in the audit, because in the planning, you already know the objective of the audit, you know what company you are going to be auditing, and then you can then pay attention to important areas, and also help to identify, your staff, selecting staff, with the right, expertise, and putting them to do work, that's would putting them in the right place, basically. And also it allows for direction and supervision of staff, right? Because when there's a plan, you know how to even direct them, supervise them. Okay, so that's why and the benefit of an audit plan. Okay, what else? Yeah, okay, yeah. So I think, that in summary, yes, now let's talk about the second part, which is the audit risk. Now, this audit risk basically talks about how the auditor is assuming his risk. Because in every audit, there's a risk, right? So the auditor wants to reduce his risk. And what is the risk saying? The risk is the possibility of giving a wrong audit report, or the possibility of giving a wrong, audit opinion, right? So there's that possibility. So that risk is what the auditor wants to work on, such that it's reduced to the minimum, right? He doesn't want to give an opinion, a wrong audit opinion. So he wants to reduce his risk to the minimum. So the risk that the auditor would express an inappropriate audit opinion, that's the audit risk. That is saying the financial statement, for instance, is true and fair, whereas the financial statement is materially misstated. That risk is audit risk, that something is bad and then we end up saying it's good. I hope that makes sense. Okay. But you don't use that word, please. Like I told you, for audit, use the right words. Don't use the English. You don't explain it. You're not explaining to your younger sister or younger brother. That's not what you're doing. You're speaking to an examiner that is highly, that expects some level of expertise and knowledge from you. So please don't explain it away in low words. Use the right words. So if you're told to define an audit risk, certain words that must be there. Word risk must be there. The word auditor, giving or expressing an inappropriate audit opinion. In fact, that keyword, inappropriate audit opinion, once you have that, you're good. All right. When the financial statements are materially misstated, and then you can then explain, further explain that the auditor, indicating that or giving an opinion that the financial statement gives a true and fair view, whereas the financial statement was materially misstated. That risk is audit risk. So it comprises of three things. All right. So we have the inherent risk, we have the control risk, and we have the detection risk. I'm not even writing. I'm so sorry. I think I'm talking faster than I can write, so that's why I'm not writing. So if I were to write, I'll be slower. So we have inherent risk, control risk, and we have the detection risk. Okay. So these are the three parts of an audit risk. Now, take note, the inherent risk are risks within the organization. These are risks that is associated to the business. Okay, it's inherent. When you say something is inherent and something is part of that thing. Okay, so it's inherent, in that. Then your control risk is also something that has to do with the organization, because it's not your own control, it's the entity internal control. So please don't mix it up. It's not your own control, entity internal control, right? That whatever it is they have in their internal control will not be able to prevent or detect, a material misstatement, or a misstatement. That is the control risk. So it is still not within your control as an auditor because you didn't create the organization. Then we have the detection risk. That is the one you as an auditor, that's the one within your control, right? But of course, what does detection risk? Detection risk says I can't control inherent risk. So if inherent risk is 50%, control risk is 30%, right? And my overall audit risk is meant to be 5%. It means the only thing I can adjust now, every organization always have, threshold. They tell themselves, okay, for us, 5% is our audit risk, 10% is our audit risk, or whatever. So what it means is if I'm going to get 5%, it means that I need to find my DR, right? Nobody's going to tell you to calculate anything. So please, it's not about the calculation, it's about understanding it. So what will be my detection risk is dependent on this multiplied by this. Is like I'm going to divide this by this so I can get DR. So the point here is detection risk is the risk that the procedures that were performed by the auditor, to reduce the audit risk. So you see how they relate, right? Audit risk is meant to be 5%. I cannot control inherent risk, can't control risk, but I can control my detection risk. Meaning, if I want to get 5%, I have to do something in such a way that this will be so low that by the time I multiply this, it will give me 5%. That's the point here. So detection risk is the risk that the procedures that were performed by the auditor. What is procedures? Audit procedures. These are steps the auditor take in order to collect audit evidence, right? So audit evidence is the basis upon which he makes his opinion. All right. So if he performs these procedures and then he is able to reduce the audit risk to an acceptable level, yes, it's in detection risk he can do that. So he wants to manage his detection risk. He cannot manage control risk. Any advice, anything he sees that is wrong in the organization, he can only provide suggestions for next time, right? So if the internal control is poor, maybe there's no segregation of duties, for instance, the account is auditing, the financial statement is auditing. As at the time is auditing, that there had not been a segregation of duties. So that happened already. So whatever is going to be advising a client to do will only surface in the next financial statement. It would only be in the next time, not in the current time. So please kindly note that. All right. So what else do you want? I remember here you want to be able to identify scenarios, right? And identify this control risk. Okay. Now you may be given a scenario at your level, not so serious, something that is good enough for your level. And you should be able to identify the inherent risk. How do you know the inherent risk? By knowing the business risk. How do you know business risk? Look at the business. Oh, this business is in buying and selling of crude oil. That is business risk. There's a business risk that currently, because of the war between US and Iran, crude oil is, let's assume they're in Iran, right? You're selling crude oil in Iran. Crude oil might be of low, they might not be able to transport or sell crude oil because of the war. And then how does that affect the inherent risk? So it affects the inherent risk because that's business issue can then have an effect on the financial statement. And the moment that happens, that's an inherent risk. It has moved beyond business risk and it hasn't gone to it. So there's a possibility that the income of that firm might be overstated. Because now that they are not able to sell, they might still want to report high income. It depends, right? So the auditor is watching out for that possibility that some of the assertions made by management might not be consistent. So it's looking out for that. So that's what we mean by inherent, risk. So you're looking out for, so how to pick inherent risk in a problem is look out for the business issues or business risk and tie it to your normal accounting. So you've learned in FR class, you've learned so many standards, right? So this is the point where you're now looking at, okay, it's a revenue issue, okay, revenue recognition. Just quickly remember FR. What are the rules to revenue recognition here? These are the rules. Okay, so the organization was identified as a contract and all of those things. From this question we can see that this is absent, so there is no supposed to be revenue recognition. However, they've gone to recognize revenue. You see, so we're now bringing a business issue, bringing it into account. But for your level, it's not going to be so extensive. But you should be able to define them and be able to explain what they mean. Okay, so I'm moving on. I hope I'm not too fast. It's also in this chapter we talked about materiality, right? What is material? Because if you're determining your risk, right, materiality matters. Okay, materiality says that, and this is, according to IFRS, right, the conceptual framework, it's clear that materiality talks about when information, if omission of that information or misstatement that is not properly indicating the exact amount, right, or misstatements of that information could actually influence the economic decisions of the users. We would say it is material. So there's really no figure anywhere to say once it's above 10,000 is material. Nope, because materiality is about size and it's also about nature. Our size is talking about the quantity in terms of the amount. Nature is talking about the quantitative, the qualitative, characteristics. So what kind of information? That's nature. Size is saying what is the degree and enormosity of this amount, and that's going to be dependent on the organization, right? So sometimes we match materiality by checking the revenue and the gross profit of the firm and say, okay, is it up to 10% of the revenue? Is it up to 5% of the gross profit? Is it up to 2% of, so if you're given a number, you're less likely to get it at your level, but in case you do, you are tying it to that and say, okay, based on revenue, this thing is about 10% of the revenue. You already know that's material, right? That's huge. Anything that's taking 10% of revenue is huge. So you want to mention that, oh, it is material, and it is about a nature issue. Oh, this information not being disclosed, that a major part of the factory has been caught by fire, and this was never disclosed, and we know that factory is responsible for about 15% of the production of goods or something, that is already about nature. There's no money in there, but we're already seeing nature. So that's what you want to remember. And then it's here we talked about types of fraud. All right, we talked about type of fraud, and we said there are two types of fraud. Basically, we have the fraudulent financial reporting, and then we have it's appropriation of assets. Okay, so the fraudulent financial reporting talks about when you alter, forge accounting records, not representing the exact events or transactions that have occurred. Misappropriation talks about, when assets, when you're embezzling, and receipt, for instance, diverting companies' assets for personal use, stealing, inventory from the business, so these are the things you're looking out for in a scenario-based question. So these are indications of fraud, right? So you want to mention, so when you see it in the question, you want to mention, oh, this is a misappropriation of asset. Oh, this is a fraud. This kind of fraud is fraudulent, financial reporting. Okay, so I think that's it about that. Who's responsible for fraud management? Always remember that. So number 6, chapter 6 talks about evidence and sampling. We're gradually coming to the, how the auditor is going to do his work. So he's going to obtain, samples. He's going to obtain evidence, audit evidence, right? But how is going to obtain audit evidence? The entire organization, your financial statement for a 1-year period, that's what we're auditing. So it means that there is a possibility that the auditor might not be able to get 100%, might not be able to audit the firm and the transactions 100%, might not be able to check every event transactions 100%. So that's where sampling comes in. So you need to audit evidence, but then you can't check 100%, then it then takes sample. But the question is it going to be given an opinion on the sample? Nope. It's given an opinion on the entire 100%. But because of the possibility of not being able to get 100% is going to be using sample, but you're still going to be responsible. If it gives an inappropriate audit report, you can't say because you use samples. Okay, so now let's talk about the evidence first. Now, what does evidence mean when we say audit evidence? Remember, the audit evidence, is how the business, the auditor would come to that opinion. Okay, so what is it looking out for? Can you obtain, as an auditor, you want to check, are you able to obtain sufficient audit evidence? Are you able to obtain appropriate audit evidence? All right. So when we talk about sufficient, we're talking about quantity. Is it enough? All right. When we talk about appropriate, we're saying quality. Is it relevant? Is audit evidence, is it relevant? Can it be relied upon? All right. So that's what we mean by sufficient and appropriate, audit evidence. So he has to decide by himself how much evidence is needed, for that engagement. Okay, and the relevance of that, engagement also, and the audit evidence. Okay, so it's also here we talked about, how you want to the hierarchy to this reliability. How do I depend on one evidence? So we say, okay, this is the hierarchy. An external evidence, is more, superior to an internal, evidence. So basically, we're saying that audit evidence that is obtained externally is better or is more reliable than evidence that are obtained internally. So the auditor, you're standing in the position of the auditor or the practitioner. If the firm had obtained and giving you information internally. So for instance, the books of account or the cash book that shows the bank statement from the cash book, right? That is, they are showing you what they are recorded based on the bank statement. And then the bank statement itself is the one the bank gives. So the question is, which one is more reliable? The one prepared by management or the one given by the bank? So that's where we say external evidence, which is the one given by the bank, is more reliable to you as an auditor in order to make a decision on the bank statement. If you're going to be evaluating the evidence and you're going to be saying anything or coming to any conclusion there, it's important to know that the one you took from the bank or got from the bank is more reliable than the one the firm gave you. All right. So we also mentioned that the audit evidence that were obtained directly by the auditor is better or reliable than the audit evidence that were obtained indirectly. All right. So for instance, as an auditor, you go into the warehouse, you observe stock count. That was directly obtained by you. Than to ask them about the stock number, which was not directly obtained by you. You indirectly took it from them. So they are the one telling you, you're just making inquiries about how the stock count went and how many stock were counted. It's not the same as when you observe, the stock count. So that's what we mean there. So another decision rule is also to verify that when audit evidence, exists in documents, is more reliable than when it is orally presented. All right, so there is a paper to a document, is better, than the management is telling you, this is what happened. They tell you they took a decision at X, Y, and X date, that this is how the decision they're taking concerning X, Y, and whatever it is. When you obtain the minutes of meetings to read that and then look at what the minutes of meeting had recorded is more reliable than them telling you, these dates we took a decision. Right. Remember that these things are your evidence. So when you're writing your report, you are basing your decision or your opinion on the fact that these were what I was able to obtain that made me say this. Okay, so another one is the original document are way better than the photocopy document. Okay, so the hierarchy is external evidence number one, the one obtained by the auditor number two, internal evidence number three, documentary evidence number four, and the lowest is oral representation. That is when you're not getting information based on what they tell you. That's the lowest of that's like lowest reliability. As an auditor, you don't want to rely too much on that. Okay, so that's it about evidence. What else? We also talked about the procedures, right? So the audit procedures here. And what are these audit procedures we're talking about? I mentioned some of them already. You need to know them because you might need them, even if the question is not directly asking them. In certain questions, you might need to say, oh, the auditor inspected, you need to use those words. So you need to know them. So they are inspection, observation, inquiry, external confirmation, recalculation, reperformance, and analytical procedures. So these are the audit procedures. Now, inspection means the auditor is inspecting, is checking the document, is checking it. That is inspecting. Observation means is watching it, how it's being done. All right. So how are sales being recorded or how is stock being counted is observing it. Inquiries is asking questions, right? Remember we said professional skepticism is asking management questions, about what he has seen, what he thinks he needs more explanation on. And external confirmation means is getting a report from an external party, is writing to the bank, from the permission of the management of the firm, for the bank to give him the bank statement or for the, if there are debtors owing, right? Customers owing, for them to give him the receivables, let him confirm that this total amount was actually receivable, So that is external confirmation. And there's recalculation. Recalculation means is recalculating the figures, punching calculators. Of course, we know we don't punch calculators, but basically what we're recalculating is checking the sum, Excel or whatever it is you want to use. So that's recalculation. Performance is doing it again. You want to see how it's done, how you guys use this. And analytical procedures says is collecting data, analyzing them, to identify patterns, anomalies, outliers, trends. That's analytical procedures. And then in this chapter, we talked about assertions. Now, typically, management are making assertions, right? So, what are the assertions? So, they're making assertions on transactions. They're making assertions on that. It occurred. So, we call it occurrence assertions. Oh, this transaction occurred, right? It happened. They're making assumptions on completeness, that it is complete. They're making assumptions on cutoff. Cutoff means the timing. We know financial reports were supposed to follow a timeline in terms of the financial period of the firm. All right. So when the auditor comes in, there are possibilities that there are some transactions that might have happened after the transaction date, or sorry, after the accounting date, that might be included in the financial statement for the other dates, for the current date in which we're in. So the auditor wants to be sure that those assertions are correct. So management makes these assertions, but he wants to check, right, are there potential misstatements in these assertions? Okay, so for account balances, assertions are existent. So these are things we say account balances, you get it seen in financial statement of financial position, where you're checking existence. So this non-current asset today, does it exist? This land, this building, this motor vehicle, does it exist? Right and obligation, we're talking about control, rights. Do we have rights over the asset? Control. Obligation is talking about is liability basically, is there an obligation for us to meet? Do we have obligations? And valuation, of course, we value asset and all. So note them, the assertions on transactions are mostly similar of profit or loss. That's why you see occurrence, completeness, and cutoff. Why for similar financial statement, you get assertions on account balances, which are existence, rights, and obligations and valuation. And then sampling. Okay, so we talked about sampling in this chapter. Sampling basically is saying we're taking fraction of a population, we're taking part of the population. We're not looking at the entirety of the population. So the question is, how do we take this? So how is the auditor going to take this sample? Is he going to take the samples arbitrarily, or is it random? Random means every item has potential of being selected. Or is it going to be using the stratified method where it categorizes them into groups and it begins to pick from each of those groups? So that's what sampling is saying, How is the auditor able to pick his samples, right? So is a sampling method, are there risk in sampling? Are there no risk in sampling? So that's what we're looking at here. Is it a statistical sampling method? Statistical is where you get to see a random sampling. Random means anybody can be selected. I go into a room, I'm seeing a pile of file. Any of those files can be picked, right? Okay, so that's statistical. But non-statistical means judgmental, no probability. They don't all have probability to pick. It's just my own opinion. An auditor to say, oh, I prefer to sample files on 15th of January, So that's judgmental already. So that's exactly what we want to talk about. So you want to remember the benefit of sampling. Why do we take samples, right? Or why isn't this, or why are samples taken? Because sometimes it's almost impossible to look at the entire population, And what are the dangers of sampling? Dangers is that the unselected ones might actually be the ones that contain the material misstatement. So probability that the auditor would, not be picking those ones. So those are the challenges with sampling. Right? Okay, then what else do we need to know? Okay, so now chapter 7, we talked about internal control, right? So internal control, we're not talking about the control internally. So very important. We talked about the COSO framework under this topic. And the COSO framework identify, certain components of internal, control. Okay, so we also identified the audit approach, test of control in terms of substantive tests. Okay, so when we talk about test of control, right? Okay, let me talk about the component first. So that's better to talk about the component of internal control. We said there are 5 components. We talked about the control environment. We talk about the information system. All right. So the control, let me talk a bit about each of them. Now, the control environment basically talks about the ethical values, integrity of management, commitment of management to competence, for instance. Those are control environment in the organization, her management philosophy, the organizational structure, that's control, environment. These are within the entity in terms of how they perceive the culture, basically, right? Then we have the risk assessment. So this is where we're talking about the objective of the business in terms of identifying risk, assessing those risks, and managing those risks. So because remember that these are components of internal control. So when you're talking about internal control, we're saying how does the business, identify, assess, and manage business risk, So that's under the risk assessment. Then we have the control activities, right? So this one, don't mix it with the control environment. Activities are talking about policies, procedures, that are not included in the control environment. Okay, so what are the policies in place in the organization? Are there performance review? What's the information processing like? The physical control, the segregation of duties, and all of that. So we talked about all of that under the control activities. Okay. Then we talk about the monitoring of control. Of course, the monitoring of control, this is where we talk about the walkthrough test. Now, a walkthrough test simply says that is a way the auditor want to have an understanding of the firm internal control. So what do? They do a walkthrough from the name. They just observe, they kind of carry out the same thing because now they play out the same scenario. Okay, what's going to happen if somebody comes in to buy this good? How are they going to do it? So you're working through it and see, okay, did they follow it? Did they do this? So you just, you watch, you're probably observing and see how that happens, and you see if the business actually, and then you're also checking it for especially for companies that use in IT now. Do they walk through tests? Did they follow the procedure? Did they eat this module? Did they eat this department before it went to this department? They're doing that. So that's a walkthrough test. Okay, so what else? I hope I didn't miss out anything. I talk about work control environment, control activity, risk assessment, information system. What else? Well, yeah. I also talk about monitoring of control. Okay, so we talked about everything. So that's what we have under the component of internal control. Okay, so then we then have I think there was something I wanted to say. I forgot. Oh God, forgotten that. So can anybody remind me when I was talking about control environment? There was another aspect I want to talk about. Ooh, can't remember. Okay, so basically that's what we have under okay, yes, I talked about test of control and substantive test. Now, when we talk about test of control, even though the next topic is on test of control, but let me just chip in something here. So when we talk about the test of control, because if you say you're looking at the internal control in organization, right? As an auditor or practitioner, you want to test that control. You want to see what's up with the control, basically, right? And that will help you to know what next to do. So you then test the control, and then you realize the control is so bad, meaning weak. We use the word weak. So you notice the control is weak. And as an auditor, what do? It means that you have to carry out substantive tests. Now, substantive test says you now begin to review each of the documents, files, transactions, events. You're going through them and to be sure that this thing happens. So because the control is weak, all right. So, but if the control is strong, right, you can probably rely on the control. Not like you should, but there's a confidence you can have. Oh, control is weak, strong. I can reduce my substantive test, right? But when the control is weak, you find out that internal control is weak, you have to do an extensive substantive test. All right, so that's something you should note. But when control is strong, you might reduce your substantive test. Okay. What else? Yeah, I think that's it on that. So the next topic, which is test of control, right? Which I expand on what I just, said. Okay, so for test of control, like I said, the auditor wants to test the control in the organization, in the client business. Okay, so what are the ways in which it can do this? It could use computers, right? So we have computer assisted audit techniques, we call them CAT. So you could use computers, to do that. And there are two forms, which is to use audit software, which is relevant when you're doing your substantive test, or use the test data, which is relevant to do your test of control. All right, so the auditor could use that to test the control. Basically, the test data involves the auditor processing the sample data through the IT system, compares the result from the process predetermined result. Okay, so it then check, okay, based on what I did, this is what I found, what I did, this is what I found. So that's testing the control. Okay, what else? Now you need to be able to understand the different control objectives for the different transaction types. So typically in accounting, there's something we call transaction cycle. Now, transaction cycle shows us the different aspects of business component, right? So let's take for instance, in the business, you have the sales cycle, or the revenue cycle. This is the cycle that helps you to track every sales, what happened. So when there's a sale, there's a possibility the customer will pay cash, they may not pay cash. If they don't pay cash, we record it in receivables. if they pay cash, cash has been received, So that's a circle, right? And then we have the purchase circle. So this is where you track what happens when the business is buying, raw materials and all of that. And then we have maybe the payroll, which is how staff salaries are being paid. And also it's experience for this examination to know the different control objectives for the different transaction circle. Okay, so if you say the revenue, for instance, what are the control objectives now? What are we saying? We're saying that the business, what are the controls in place when they make sales? Remember that when you make sales, right, you will first of all probably get an order from your customer. And then if you have what they were looking for, you dispatch the goods to them or you invoice them and then you dispatch the goods to them and then you record that sales in your books, right? In your sales and if they paid in cash, you record and all. Now, your test of control is, did the business follow a set of system, when sales are made? That's what you want to test. All right, so and then you test and you realize that, oh, they didn't. The control is already weak, right? So the goal or the control objectives are, for instance, okay, as an auditor, all the orders that were received from the customer, were they processed? When they sold goods to the customer, did they sell to them above their credit limit? If they had credit limit, for instance, if you were to give them credit, did they sell above the credit limit or not? So you want to understand the different control objectives for sales, for revenue, for payroll, okay? For revenue, for instance, and for purchases, what are you looking out for? Okay, so you as an organization, you'll be placing an order, you'll be requesting for an item, and then there's like a requisition form that must be filled. You then place an order, and then you probably then receive the goods from the from the supplier, and then you record that you have made a purchase, right? So the question is, what are the control objectives, whenever you have purchases? Okay, so because we're going to test that. Okay, so do we have a situation where the different people, the segregation of duties are hopefully the person making requisition is not the same person that will be approving the transaction to the goods to be bought or something. So these are the things you want to check. For payroll now, payroll is talking about staff, right? So how are they calculating their salaries, their wages? How is it being recorded? Are there taxes for them to pay? How is it calculated? And how eventually do we get to pay them? So these are the elements, right? So this one you will know like from normal life. But the question is, what are the objectives of that? When I say my control objectives, I want to be sure as an auditor that, for instance, taxes are properly calculated, deductions are properly made. I want to, check for those things. So that's what my test of control. Test control. So those are the things. So please, I will advise you go through the slides to help you to remind you on how this works. Okay. So please, the next one is, yes, we're now into the substantive procedures. Like I said, it's a 4-part series, substantive procedures. So you should be able to, because this one is practical, most likely the questions are going to be practical. This is where they give you probably a scenario. They want you to identify the procedures or the audit. So it may not be the what substantive procedures might not be used. They might just tell you what are the audit procedures to be performed on this, right? So what are the audit procedures? So I'm going to merge these 4 topics together. I'm not going to too much separate them because I believe if you're going to be learning them, you have to learn them together, right? Because they all just talk about the same thing, but just that is applied to different aspects. So the first one is saying general information. So I'm going to say, what are the substantive procedures to a non-current asset? The next one is, what are the substantive procedures to the current asset? And that says, what are the substantive procedures to other assets or other elements in the financial statement? So you want to learn them in unison, because if you understand certain words and you keep using them, whichever way they come up, you'll be fine. So my point here is, if you understand that, okay, when we say substantive test, the auditor is testing something. So the question is, okay, what is it testing? Oh, it's an asset account it's testing. Oh, it's something in the non-current asset account is testing. So that's just the difference. But the issue is still testing something, is doing a substantive procedures. Okay. So if, for instance, we want to do like a substantive procedures on a non-current asset, you want to quickly picture what a non-current asset is. Picture what you get to see in your FR. Picture that, oh, in your non-current asset schedule, we have this element there. So you want to quickly picture that. So depending on what the question says, you run with that picture, right? So you must have like a practical picture of what the issue is, not just to cram the procedures, because it will be too much to just cram it without understanding why you're even cramming. So if you take um, a non-current asset, for instance, right? You know that management, for instance, will be making assertions, right, on the existence of that, asset. Oh, it exists, right? Okay. So what are the indicators there? We're looking at the cost of the asset. You want to confirm the cost of the asset. And how do you confirm that? You want to check the purchase contracts, receipts, invoices. Yeah. So when they say substantive procedure, we're saying, okay, how do we agree with the assertions made by management? Should we agree that this asset existed? Okay, it did not. How do we know it existed? Okay, what are the invoices associated with this asset? Receipts associated with this asset? Were there purchase invoices and all of that? So these are the things you're looking out for. Okay. So if you look at depreciation, because non-current assets are, they are prone to depreciation. So what are the rates, or what is the rate of depreciation? What is the method? What's the useful life? What's the gain or loss on disposal? Even after the asset has been used in the firm. So these are the things. So you want to picture real things you've learned in your FR, and then begin to ask questions. Okay, how do I know this thing is existing? That assertion of existence. How do I know? I'm checking this, I'm checking this. Okay. And so we also have the purchase goodwill, because under non-current asset, they also included the goodwill. Remember that your standard was clear that goodwill will only be recognized at business acquisition. Okay. When a parent company acquires a subsidiary, that's when goodwill comes to light. Okay, so on no condition should a company be valuing goodwill based on reputation. So these are things you're testing. So that's why people say FR and A, or financial reporting and audit, they're like siblings, right? Because if you have a debt or kind of understanding in your financial reporting, if you're given a scenario question, you can just bounce off on it. Not like you're going to calculate anything, but if you're able to speak to it based on the auditor is actually auditing the firm using an applicable financial reporting framework. And that financial reporting framework for us in Nigeria is IFRS. So everything IFRS is concerning an element of financial statement is what the auditor is checking. Is it consistent with it? So there is no way you can do well in this topic, this from chapter 9 to 12, without having a good understanding of, IFRS is applied to the different issues that might be brought to you. Okay, so we also talked about intangible, assets. These are assets that could have been developed in the firm. All right, so there are ways in which intangibles are, recognized. Of course, IS 38 was very clear on how this will be. So, for instance, if it's an internally generated intangible asset, where the business generated it, not like they purchased it. All right, there's some intangible assets you purchase, license, you pay for it, but there's some intangibles you didn't purchase, you develop them within the organization. So there are checks. Okay, so the question is this technically, feasible Is there any form of technical feasibility that the internet asset will be completed? Is there an intention to complete it, the ability to use or sell it, economic benefits arising from it? So everything you learned yesterday, you want to mention them in case you get a question. So don't be afraid to mention. The only thing you will not do is to calculate anything. All right. So just mention them, to show that, so you know what the standard says and you're doing your substantive procedures, which is to check these things and see if they really exist. So that is how you want to treat this topic. All right. So chapter 11, still on substantive procedures. This time we're saying for current assets now. What are you looking at for current assets? Very important. Inventory, cash, bank, right? So if you start with inventory, what standard? So you see where standard matters. What standard are you looking at for? IAS2 immediately. What did IAS2 say? Inventory should be recorded at lower cost and net realizable value. As an auditor, what are you checking? Did the company follow that? How will you know? Heck, are there indicators of obsolescence in the inventory? Are there inventories that have not been sold for a long time? Are there inventories that the last time it was sold, was really long time? Have the inventory suffered theft or loss or deterioration? These are things that would tell you that this asset can no longer be valued at cost. We should now be considering the net realizable value, which the standard says it has to be the lower of both. All right. So for the fact that question says they bought it at X, Y, and Y, that's not the issue. Are we checking that this net realizable value of this asset is no lower than the cost? All right. So you are going to be importing your IFRS knowledge in this case, right? So that's how you want to look at it. Now, what else? Like I said, inventory, yeah, I've talked about that. Oh, yeah, we want to mention how inventory has been the methods of valuation. We have the first in, first out one, we have the average cost. You want to check that the organization has followed either of this one. Raw material inventory, work in progress, clear cutoff, not including raw material into work in progress or including into finished goods. And then the work in progress itself, there's other components because when you say work in progress, it's not just the raw material we're looking at again, we're looking at the labor that must have been associated to that, goods, the production overheads, we're looking at all of that. So when it comes to inventory, you question, is it at the raw material stage? Is it at the work in progress stage? Or is it at the finished goods stage? So you want to bring that. So I also say your cost accounting might be of help a bit here, just in valuation and all of those things. Just not calculation now, but just to be able to understand and write, based on what the standard says. These are the things the organization have done. So inventory too, we're talking about the count of inventory. The management does the count, auditor observe the counting, okay? And it can also count some things, just not like the entire thing. Might just pick some boxes, open them up, check. So if a box is, maybe they say there's a box of 20, it checks few samples. Do we have 20 in each of the boxes or are they just empty cartons? So these are things you're looking out for in inventory. Also, when is the inventory counted? Were they counted before the end of the reporting period? Remember that the audit financial statement is the end of the reporting period. So were they counted before? Because it takes time to count inventory, right? Or were they counted, after or towards the end? So very important, and identifying the cutoff, right? So like I said, knowing what to include and what not to include. For instance, the sales were made on the 1st of February, and let's say accounting year ends every March 31st for this firm, and then sales happened in February, but money came in June, right? So when is the cutoff? It doesn't matter when the money came in. What matter was inventory was sold before the reporting year end. Okay, so and that's what we want to recognize that cutoff, is clear. We don't put the wrong elements in the wrong date. So that's what the cutoff is saying, both for sales, both for purchases. That's it. What else? Yeah. So in summary, that is what this is about. Let me just touch a bit about the other aspect of substantive tests, which is chapter 12. This one contains where you have your trade, trade payables, how do we do that? Your accruals. Now, for your, proud now we've done non-current asset and a current asset, okay? But for your payables, the issue with payables is not the same issue with asset. Now, the thing is, assets are most likely to be overstated. So most likely a firm would overstate their assets just to have a better net worth or to show profitability. So they will overstate their asset. But liabilities are less likely to be overstated. Most times they are understated. You don't want to report you're owing a large sum of money. You want to report you're owing a few amount of money, right? So you need to understand that psyche with businesses, right? So liabilities are likely to be understated. Assets are likely to be overstated. But what is important here is when it comes to trade payables, so it's not even about, oh, you want to check the records. You want to, because it's likely to be understatement stated. That means the records were not even there in the first instance because they don't want to report it at all. It's not even there. So you have to obtain audit evidence somehow to know whether there are liabilities. And how do you do that? External confirmation, right? You want to know, so those are some of the things that, you want to look at when it comes to that. What else? What else? What else? You know, yeah. So that's it. In short. So now let's go to the next topic, which is audit completion and reporting. Audit completion and reporting. That's chapter 13. Now, this is like the final when it comes to auditors reports and all that, right? So, but what are we looking at here? We're looking at for written representation. Very important. See that thing called written representation is very important. Now, these are letters, from management. So when we talk about written, they have letters from management, that the auditor would have requested from them, for them to acknowledge, their responsibility and also to provide relevant information on certain things. Remember, we said that a documented evidence is better than an oral evidence. So a documented evidence, an oral evidence does not have document backing it up, right? But when you ask for certain things, maybe the way they've estimated certain things in the financial statement, and then you want them to give you a written representation that they've done it fairly, it's a good estimate based on the use of experts. So you need fitting representation from them, just so that you are sure that they've correctly, done it. Okay. So what else? Under audit completion, there's a lot there anyway. So let me, yeah. So we talked about the written representation being what the management would have to provide to the auditor, whose responsibility for that management, what are the content of that. The auditor will draft it because he is the one that is the question on them providing more clarification on certain areas. And then the management write it, they address it to the auditor. Things that you likely get to see in a written representation, you get to see things like them writing about that they've disclosed the related party transactions, events after the reporting period, the uncorrected misstatements, then the company disclosing that they are if there are information that are relevant to fraud or suspected fraud, they've disclosed that, and that they are also disclosed non-compliance with law, if there are, so basically it's just for them to tell you what happened and just give like a document, explaining some of these questions, So that's it about written representation. Okay, so the other next part is the auditor's report itself. Okay, so the auditor's report is where the auditors then pen down what he thinks, his opinion. But of course, there's the elements of the auditor's report. So in the auditor's report, you get to see the title of the auditor's report, which is called Independent Auditor's Report, the person addressed to shareholders of the firm, the auditor opinion itself, then the basis for the opinion. And then there are other issues now. If the auditor, feels that the company has some materiality, certainty in the ongoing concern, you want to assess, what management has said. Are they, is their basis or assumptions in line with the reality? So, if a company could either prepare financial statements on a going concern basis or on a breakup basis, right? So let's assume the company is on a going concern basis, and they've also indicated that in their, their assumption. Then we know there's no problem, no modification of, but when they say the company has a is on going concern basis, whereas company is not, then the auditor will have to express, a modified opinion, right? Because that's not true. But if the company has also said there's no likelihood of going concern, yes, there's no need to give a modified opinion. They've already agreed the fact that they are not even going concern, and that's exactly what happened. So there's no modification of report there. So you want to understand that. Then we have the key audit matters. Now, the key audit matters is that aspect where the auditor, include matters that he found significance in the course of his audit. Now, this does not qualify an audit opinion, right? So, if you ever see key audit matters in the auditor's report, it doesn't say the financial statement was not true and fair, right? It's different from giving an adverse or a disclaimer or a qualified opinion. Is a different thing. Key audit matter is just saying I can give you an unqualified audit opinion, right? But I could still address or outline matters I found significant in the course of my audit, and that's what the key audit matter is about. Okay, and then we have the, of course, auditor responsibility stated, management responsibility stated, and that's what else. Yeah. Then we have the expectation gap. Now, the expectation gap, same question directly asks this question: what are the types or elements of expectation gap? An expectation gap basically is that gap between what the public think of the responsibility of the auditor, how that is different from what the statutory requirements had stated about the responsibility of the auditor. So there is that expectation gap, right, where the public feel the auditor should do better by detecting fraud or by preventing fraud. But auditor's responsibility or statutory responsibility does not indicate that, right? It only says they should give an opinion. However, if they find fraud, they can disclose. Of course, they should. So, but their job is not to look for fraud. Okay, so that misunderstanding is there, and that's what the expectation gap is about. So we have the standard gap that speaks to the fact that the audit standards are prescriptive than they are actually, and the auditor have wide-ranging rules they must follow, which is not really true. All right, so we have the performance gap that the auditor work has actually fallen beyond their expectation, the expected required expectation also. And the auditors have a responsibility for detecting fraud. Is that true? No, they don't have responsibility for detecting fraud. Now we have a liability, gap. So in terms of who should the auditor be liable to, so that itself is an issue. So are they liable to management? So those are the issues. So of course, the shareholders they are liable to shareholders, but there are expectations that anybody can just sue the auditor. So those are issues around expectation gap. So that's audit completion and reporting. Then we have the next chapter that talks about the business system and IT risk. I want you to take a bit of understanding in this chapter and a bit of particular attention to this chapter because this is tech, right? So the business system and associated information system risk. What should you be going on with here? Understanding the business system itself, understanding the different aspect of the business. We have the sales, human resource, the finance, product development, corporate services. These are the different aspects of the business. They want to understand the emerging technologies that has come to disrupt, audits, and these are cloud-based, cloud computing, big data, blockchain, artificial intelligence, and social media. So you should know these things, be able to explain them. All right. So these are issues. So what are the areas, in audit that this tech has come to impact on? So you want to identify, it has impacted in audit engagement, on risk assessment, evaluation of internal control, in substantive testing. So in reporting. So because we can now use, IT to, for instance, do substantive tests by, the software just checks for issues, trend analysis, so those are how tech has come into impact on auditing. And then you want to talk about the types of information system in terms of the component first, hardware, software, database, procedures, and all that. So yeah, and types of information system in terms of executive information, decision support, transaction processing system. So then into the core IT, we're looking at the risk technology has come forth with, in as much as it's come to ease the work, it also came with other risk. Now have insider fraud now, password theft, hackers, denial of service, software failures or hardware failures, malware threats, virus, spam, phishing attacks, natural disasters that can even cause physical harm, human error, and all. So these are some of the risks in IT, as impact on audit. Okay. Then the last one, which should pay attention to, is forensic accounting service. And this chapter, pay attention to it. All right. So I think we'll just take a question on this one, a past question on this one, so that we would so I'll drop the question on the group so that you get to see how it was examined in the last diet. Okay, so I'll just drop it on the group, on the SEPTA Bridge group. Let me drop it there so that you can all see it. So that was how it was asked in the last diet. And basically, you want to pay attention anyway. We're not saying it's coming out again, but pay attention. So they literally almost asked different aspects of forensic accounting, talking about negligence, the skill set, code of conduct, expected of a forensic accountant. So you want to remember all of that. Okay, yeah. So that question, you want to look at it. Okay, so what else? So we're done with the overall summary of this. So, but let's take a practical session and see how questions can be asked. So I got a case study question here or a scenario-based question. So you see how you should not you should be answering this question without being misled. Right? Some questions can be misleading. So let me post that question too on the group so that it's easier for everybody to just follow. I hope everybody listen to me on the group so that you can get the question. If you are not, let me know so that I think of how to send it to you. Okay. Okay, good. Found the question. take a look. It's on the group. I just want to use this question to demonstrate to you how not to be misled. So I believe we have access to the question now. So let me read so that you guys can follow. So it's a question one. So I like question ones because they're always like, intense. So it says in an accountancy class on audit opinion in international standards and audit. Okay. Ado, a lecturer at Icahn University, was explaining to the students. See, can you see story? It's going to just be interesting to you. Was explaining to the student that the end product of external audit work is the auditor's opinion expressed on the financial statement. He stated that the general purpose financial statement was in compliance with the financial reporting framework designed to meet the common financial information needs of a wide variety of users. The role of audit is to provide a high level of assurance to the users. You see, you want to write, yes, you want to put your opinion there. That's true, that's the role of the audit. But that's not yet the question. Do you want to be calm? To the users of the financial commander, it's necessary for users to have confidence that are consistent accounting standards have been applied in the audit of financial statement of companies. We went further to explain that the overall objectives of the audit of the independent auditor to ensure that the conduct of an audit is in accordance with international standards on audit. We concluded that the auditor's report shall include a section with the heading Opinion as stated below. So the opinion says, we have audited the financial statement of Energy PLC set out on pages XXX to XXX, which comprises the statement of financial position as at the year ended, and the statement of profit or loss and other comprehensive income, the statement of changes in equity, and the statement of cash flow for the year ended. The notes to the financial statement, including a summary of significant accounting policies. In our opinion, the financial statement gives a true and fair view of the financial position of Energy PLC as at year end date and its financial performance and cash flow for the year ended in accordance with international financial reporting standards and the requirements of the Companies and Allied Matters Act 2020 and the Financial Reporting Council Act 2011. At the end of the lecture, a student in the class came to you for further explanation to the topic. Is that a question? Not yet. So don't be carried away because this one was a trap. You will then now begin to explain what you say to the student, but that's not what the question has asked you. Required is where you move. You move requirement. Okay, I've read this story. What does requirement say? It says required state the objectives of the independent auditor as stated in international standards of audit. So you have to, so why are you wasting your time explaining to the student what you would have told them? No, that's not the question. The question says state the objectives of an independent auditor in line with the ISA. So you have to state what are the objectives of an auditor to obtain a reasonable assurance about whether the financial statement is free from material misstatement, all right, or whether due to fraud and error. So it's just going to make his opinion on that. And also to report the financial statement and communicate as required by ISA. So that is objective. So the next question says, outline what ISA 200 requires the auditor to do in relation to the audit of the financial statement. So you're not going to be talking about the story, the requirements. If you notice this requirement did not even tell you, link it up with the case or something. It was just like independent of that story, like this same question could have been asked without this story. All right. So, but the students make me think is to go be writing about the story, not even answering the question. So the second one says, the requires Atlanta Water ISA 200 requires the auditor to do in relation to the audit of the financial statement. What are they required to do? They are meant to comply with the relevant standard of audit. They are meant to have, the relevant ethical requirement, possess professional skepticism, be able to exercise their professional judgment for them to obtain sufficient and appropriate audit evidence. So you see, that is how you get to use these words that you've learned. So that is how you want to answer that question. Then the C part says, explain the scope of audit as required in independent audit report. What is the scope of audit? So what's the scope? The auditor wants to obtain audit evidence about the amount and disclosure in financial statement. Okay, so the procedure selected will depend on the auditor's judgment, including how he has assessed the risk of material misstatement. In doing so, he would consider the internal control of the firm and give his verdict on what the state is, whether it's effective or not. So this is how you want to just approach the question. The last one says, highlight the role of regulatory bodies in ensuring that the audits are carried out in line with standard. Okay. So what are the roles of a regulatory body? For instance, ICANN offers the provide qualifications for auditors by making them write the minimum level of professional qualification exams, like what you're doing, for them to ascertain their technical competence. So that's it. You also want to be professional bodies or regulatory bodies want to be sure that the audits are performed by fit and proper person, and that the auditor have acted with integrity. They want to be sure that they have a list of registered, auditors that are available to the public. So these are things. So you see how questions can be asked and how you should not be misled. So I just brought this out so you see that. Okay. So I think it's time for me to get the questions. We've done almost 2 hours. So let me get your own questions now. Anyone? Can I get questions from anyone? Or there are no questions? Belo, Jakub, questions. Felix, questions.
None from me at the moment.
Okay, none from Precious. Okay. Adepoju, Anoluwapo, Felix. Okay. Islamiat, Mukwelola.
Not for me, ma.
None for you too. Okay. So no questions. Was the session impactful? What did you learn? Anyone? Was it impactful? Was there something? I know the times are great now. I know. I know. I know.
Yes, but yes, it was more of a crash course for me. So yes, it was impactful.
Okay. Thank God. Thank God. Okay. All right. So let me let you guys, because I know right now everybody is, finishing touches and all of that. So if there are none, I think I should allow you guys go to do other things. All right. Thank you very much for attending the session. So we would see at the chartered accountant side. So for those that will move it to the next level, we'll be seeing at the next level. I'm not seeing anybody back in this course. None of you is coming back. So I'm only seeing you at the next level. Obviously, everybody's moving to the next level. So see you at the professional stage. Bye, everyone. Success in your exam. Thank you, Mupe. Mupe was clapping for me.
Please,
Thanks.
would we get the recording also?
Hey, yes. I'll put
Okay.
a recording. Oh God. because I'm using Teams, I'll put it on the platform, but I know some people are not on the platform. But I mean on the platform, on the
Yes, I'm
Scepter,
not there yet, but I'll go and look for the link.
on the Scepter bridge, you're there, Precious.
Okay, on the platform, okay.
Yeah,
Okay.
where you took your classes. So I'll
Yes,
drop the
yes.
video on the other. You were added to two platforms, right? The AF, through AF, right?
Okay.
So yeah, so I'm gonna drop it on the other one, the one that has tutorial. I'll drop it there. But for all that, if you
Okay.
can navigate Teams, you can always still come back to watch it from this one. All right. Thank you so much for everyone that
Oh,
clapped
okay.
for
Okay.
me. All right. Bye.
All right. Thank you.
Thank you so
Welcome.
much, ma'am.
You're
Good night.
welcome.
Thank you so much, ma'am.
Good night. You're welcome, everyone. Peculiar, you're welcome. Precious, you're welcome. Deborah, you're welcome. Arefa, you're welcome. Bello, welcome. Felix, welcome. Odukoya, welcome. Kesirat, welcome. Okay, so please go read and or sleep. Bye.